welcome to A Prayerful Life, A Balanced Life. This is episode 2, Intellectual Aspect. We're going to talk about accounting. Let's start with accounting basics. If you're an aspiring entrepreneur running a small business or just want to learn accounting basics in general, here is an overview. It starts with the conceptual understanding. Accounting is the financial management, what a foundation is to a building. Accounting helps you keep track of three important things: tracking income and expenses, ensuring compliance with tax laws, making informed decisions that drive growth. The idea behind grasping accounting principles is to become better equipped at budgeting wisely, forecasting future financial needs, and maintaining the overall health of your business. To explain accounting basics, I'll start by giving a glossary of essential terms. Then I'll dive into definitions, type of accounting, and basic accounting principles. I will also discuss the basic accounting tasks that small business owners need to take care of and skills that are valuable in the field. Basic accounting terms. Number 1, debits and credits. Not to be confused with your personal debit and credit cards. Debits and credits are foundational accounting terms to know. I remember the difference between the two as follows. A debit is a record of the money expected to come into my account, while a credit is a record of all money expected to go out of my account. Essentially, debits and credits track where the money in your business is coming from and where it is going. Many businesses operate out of a cash account or a business bank account that holds liquid assets for the business. When a company pays for an expense out of pocket, the cash account is credited because money is moving from the account to cover the expense. And this means the expense is debited because the funds credited from the cash account are covering the cost of that expense. Here's a simple visual to help you understand the difference between debits and credits. Debits increase assets. Credits decrease assets. Debits decrease liabilities. Credits increase liabilities. Debits decrease revenue. Credits increase revenue. Debits increase the balance of expense accounts. Credits decrease the balance of expense accounts. Debits decrease the balance of equity accounts. Credits increase the balance of equity accounts. As a summary, for debit, it increased assets and the balance of expense accounts. And on the other hand, it decreased liabilities, decreased revenue, decreased the balance of equity. It's the other way around with credits. Number 2, accounts receivable and accounts payable. Accounts receivable is money that people owe you for goods and services. It's considered an asset on your balance sheet. For example, if a customer fulfills their invoice, my company's accounts receivable amount is reduced because less money is now owed. Accounts payable is money that I owe other people and is considered a liability on my balance sheet. For example, let's say my company pays $5,000 in rent each month. Here's how that would be recorded in financial records before that amount is paid up. July 31, rent, 5,000, debit. Accounts payable, 5,000, credit. Once that value is paid, here's how that would be recorded in your company's financial records. August 1, accounts payable, debit, 5,000, and credit cash account, 5,000. Number 3, accruals. Accruals are credits and debts that I've recorded but not yet fulfilled. This could be sales completed but not yet collected, payment on or expenses made but not yet paid for. Number 4, assets are everything that your company owns, tangible and intangible. My assets could include cash, tools, property, copyrights, patents, and trademarks. Number 5, balance sheet. A balance sheet is a key financial statement that shows where my company stands in terms of assets, liabilities, and owner's equity at a specific point in time. When I look at my balance sheet, I see a clear picture of what my business owns, what it owes, and the net value left over for the owner's equity. Burn rate number 6. Burn rate is how quickly the business spends money. It's a critical component when calculating and managing cash flow. To calculate burn rate, I simply pick a time period such as a quarter or a year. Then I subtract the on-hand cash amount at the end of that period from the on-hand cash at the beginning. Lastly, I divide that number by the number of months in the period. Remember, you can choose your own cadence or cadence, which you can then use for dividing. 7. Capital. Capital refers to the money I have to invest or spend on growing my business, commonly referred to as working capital. Capital refers to funds that can be accessed like cash in the bank and don't include assets or liabilities. Number 8. Cash flow. Cash flow refers to the balance of cash that comes into and goes out of my business during a specific period. I keep track of this in a cash flow statement, which helps me see how well my company is managing its cash. For example, if my business receives 10,000 from sales in a month but spends 8,000 on expenses like rent, salaries, and supplies, my cash flow for that month would show a positive balance of 2,000. Monitoring cash flow is crucial because it lets me know if I have enough cash on hand to cover my obligations and invest in future growth. Number 9. Chart of accounts. The chart of account is something that can be used as a master list of all the accounts in my organization's general ledger. It's like a roadmap that helps me organize and categorize every financial transaction, making it easier to track and manage the company's finances. The COA includes 5 main types of accounts: assets, equity, expenses, liabilities, and revenues. If I need to record the purchase of office supplies, I would look to the COA to find the appropriate expense account where this transaction should be logged. This system keeps everything in order and ensures that all financial activities are properly documented. Number 10. Cost of goods sold. The cost of goods sold, or cost of sales, is the cost of producing the product or delivering the service. COGS, or cost, is the first expense you'll see on your profit and loss statement and is a critical component when calculating your business gross margin. In my opinion, reducing your COGS is the best way to increase your profit. This way, you can stay net positive even if your sales aren't increasing. Number 11. Depreciation. Depreciation refers to the decrease in assets of value over time. It is important for tax purposes as larger assets that impact the business ability to make money can be written off based on their depreciation. Number 12. Diversification. Diversification is a risk management strategy that helps avoid putting all my financial eggs in one basket. By spreading my investments across different industries or asset classes, I can reduce the risk of losing a significant portion of my capital if one area underperforms. For example, instead of investing solely in tech stocks, I might diversify by also investing in real estate, bonds, and healthcare stocks. This way, if the tech sector experiences a downturn, the impact on my overall portfolio is minimized because my investments are spread across different areas. Number 13. Equity. Equity refers to the amount of money invested in a business by its owners. It's also known as owner's equity and can include things of non-monetary value such as time, energy, and other resources. I like to remember equity as the difference between my business assets. A business with healthy equity is attractive to potential investors, lenders, and buyers. Investors and analysts also look at your business EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. Number 14. Expenses. Expenses include any purchases you make or money you spend in an effort to generate revenue. Expenses are also referred to as the cost of doing business. There are 4 main types of expenses, although some expenses fall into more than one category. Fixed expenses are consistent expenses like rent or salaries. These expenses aren't typically affected by company sales or market trends. Variable expenses fluctuate with company performance and production, like utilities and raw materials. Accrued expenses are single expenses that have been recorded or reported but not yet paid. Operating expenses are necessary for a company to do business and generate revenue like rent, utilities, and payroll. Fiscal year fixed costs. Fiscal year is a time period a company uses for accounting. The start and end dates of your fiscal year are determined by your company. Some coincide with the calendar year, while others vary based on when accountants can prepare financial statements. Number 16, gross margin. Your gross margin is your total sales minus your COGS. This number indicates your business sustainability. 17. Income statement. An income statement, also referred to as a profit and loss statement, is a financial document I use to see how much my business has learned and spent during the specific accounting period. It shows me the total revenue my company brought in, subtracts all the expenses incurred, and helps me determine whether I made a profit or loss during that time. For example, my business earned 50,000 in revenue over a quarter but had 30,000 expenses. My income statement would show a net profit of 20,000. This document is essential for understanding my company's financial performance and making decisions about future operations. Number 18, inventory. Inventory refers to the assets of my company holds with the intention of selling them through our operations. This includes not only the finished goods ready for sale but also items currently being produced and the raw materials or components used in production process. Essentially, inventory encompasses everything from the materials we start with to the final products we aim to sell to customers. Number 19, liabilities. Liabilities are everything that your company owes in the long or short term. Your liabilities could include a credit card balance, payroll, taxes, or a loan. Profit. In accounting terms, profit or the bottom line is the difference between the income, costs, and expenses, including operating interest and depreciation expenses. You are taxed on your net profit, so I believe it's important to plan for your tax liability proactively. Do this by staying on top of your net profit amount, setting aside some of your revenue in a separate savings account, or paying your estimated taxes every quarter. Like employer withholding. 21. Return on investment. Return on investment, or ROI, is a metric used to measure the profitability of an investment, usually expressed as a percentage. To calculate ROI, divide the net profits from the investment by its initial cost and then multiply the result by 100 to get a percentage. Revenue. Revenue is the total amount of money collected in exchange for goods or services before any expenses are taken out. 22. Trial balance. A trial balance is a report used to check the balances of all the documents or accounts in my general ledger at a specific point in time. I usually prepare a trial balance at the end of a reporting period to make sure that everything adds up correctly before finalizing my financial statements. For example, if I've recorded various transactions throughout the month, I generate a trial balance to see if the total debits match the total credits. If they do, it confirms that my accounts are balanced. If not, I know I need to investigate and correct any discrepancies before moving forward. 23. Variable costs. Variable costs are expenses that fluctuate based on the amount of goods and business produces or sells. Let's assume I'm running a manufacturing company and decide to double my production. My costs for materials and labor would increase accordingly. These are variable costs because they rise and fall within the level of production. For example, if I produce 1,000 units of a product and the cost of raw materials is 5,000, producing 2,000 units by trace that costs 10,000. This change in expense directly ties to the increase in production, making it a variable cost.